Globe Life officially beat the street's consensus this quarter. We're looking at top-line premium revenue of $1.29 billion, which is a solid 7% bump, and bottom-line net income of $3.65 per share.
Yeah, and they were confident enough to bump up their full-year guidance, too. They're now targeting a midpoint of $15.75, and the stock definitely reacted positively after the bell, especially with book value up 11%.
Right, sitting at $100 or 4 cents per share now. So today we're pulling all our insights from a single source, which is Globe Life's Q2 2026 earnings release that just dropped on July 22nd.
Exactly.
Our mission for you today, as always, is to cut through the dense corporate jargon. We want to decode exactly how this insurance behemoth generates its cash flows, look at the stark differences between their life and health divisions, and, dig into the specific macroeconomic risks they're currently sweating.
It really is a textbook case study in corporate operating leverage, but, and we'll get to this, there are a few surprising contradictions hidden in their agent sales data that we absolutely need to dissect.
Oh, for sure. But before we figure out how the machine works, let's unpack those profitability metrics we just mentioned. Because the earnings release actually highlights two different earnings per share, or EPS, numbers.
Right, the GAAP versus non-GAAP.
Exactly. There's the standard net income at $3.65, and then a slightly lower net operating income at $3.61. When I look at this, I always kind of view GAAP net income, which every public company has to report, as your total bank deposit for the month.
Okay, I like that analogy.
Right. Like, it includes your standard salary, but maybe you also sold your used car for $3,000 in cash, so the total deposit looks huge for that specific month. Net operating income, on the other hand, is your actual, reliable, everyday paycheck.
Yeah, it strips out the noise.
Exactly. So knowing that operating income strips out those one-time windfalls, why does management insist on highlighting that non-GAAP measure to retail investors?
Well, because in the insurance industry, the standard GAAP rules can actually obscure reality pretty badly. Management strips out the noise to show you the core business engine. In this specific quarter, the difference between that $3.55 of standard net income and the $3.61 of operating income is largely driven by realized investment gains.
Got it. So they sold some stuff.
Right. They had about 7 cents per share of profit just from selling investments, which is offset by a few cents of legal costs. But if you were evaluating Globe Life's long-term viability, you want to know how good they are at their primary job, which is underwriting risk and collecting premiums.
Right, the actual insurance part of the insurance company.
Exactly. If they happen to sell some bonds at a profit one quarter, that's a nice little bonus for the balance sheet, but it doesn't tell you if the underwriting operations are actually healthy. Net operating income gives you that clear, unclouded picture. And by that specific metric, seeing a 10% year-over-year increase to $3.61 per share, which is $284.6 million in total, is exactly what you want to see. It marks double-digit growth in 8 of the last 9 quarters.
That makes perfect sense. You want to measure the engine, not just a temporary tailwind. And looking at their return on equity, or ROE, that engine is humming. Net income as an ROE was 18.4%.
Which is very strong.
It is, but just like with the earnings per share, they offer an alternative metric here too, a net operating income, ROE, excluding AOCI, which sits at 14.3%.
Right, and we should probably clarify what AOCI is for anyone tracking their portfolio.
Yeah, please do.
It stands for Accumulated Other Comprehensive Income. Since Globe Life is sitting on this massive portfolio of bonds, their AOCI captures the daily paper gains or losses caused by interest rate fluctuations.
And that is a crucial distinction, right? Because when the Fed moves interest rates, the fair market value of Globe Life's bond portfolio swings wildly on paper.
Huge swings. But the reality is, they hold almost all of those bonds until they mature. They aren't out there actively day trading them.
Right.
So those daily paper swings are largely irrelevant. They aren't realized losses or gains. By excluding AOCI from the calculation, management is essentially saying, look at the actual tangible capital we deploy to write insurance policies.
It provides a stabilized view of the equity actually working inside the business.
Precisely. And, generating a 14.3% return on that actively deployed capital is a really strong indicator of pricing discipline. They are pricing their policies correctly to ensure a high return.
Okay, so we know they had a highly profitable quarter. Now we need to transition into exactly where that revenue growth is coming from.
The fun part.
Right. The earnings release splits their premium revenue into 2 massive buckets, life insurance and health insurance. And the contrast here is just fascinating. Life insurance is clearly the heavy anchor of the business.
Oh, absolutely.
It accounts for 66% of their total premium revenue, bringing in $860.7 million this quarter alone. And it is incredibly profitable. It drives 78% of their total underwriting margin. But, and this is the crazy part, life premiums only grew by a modest 3% year over year.
Yeah, it's steady, but it's very slow.
Right. But then you look at their health insurance segment. It's much smaller. It accounts for 34% of premium revenue, but it saw a massive 16% jump, bringing in $436.8 million.
It's a huge spike.
To put a mental model on this for everyone listening, life insurance feels like a reliable anchor store at a mall. It's predictable, you have decades of actuarial data, the margins are locked in, but this current health boom feels more like a trendy pop-up shop that is suddenly driving all the new foot traffic.
That's a great way to look at it.
So my question here is about trajectory. With health growing at 16% and life plodding along at only 3%, is Globe Life secretly transforming into a health insurance company, or is this just a temporary imbalance?
You know, that is the critical tension running through this entire earnings report.
Hmm.
I wouldn't say Globe Life is abandoning its identity, but they are clearly leaning hard into a specific market opportunity in supplemental health. You hit on the mechanism perfectly earlier. Life insurance margins are the bedrock.
Right.
At $359 million in underwriting margin this quarter, life insurance operates at a massive 42% margin against its premiums. That is the cash cow of the enterprise.
It pays for the lights to stay on.
And then some. Health insurance, on the other hand, while it's growing its top-line revenue rapidly at 16%, it operates at a much lower margin. It's about 23% this quarter, yielding roughly $99 million in underwriting margin.
Oh, okay.
The mechanics of health claims are just different. They're more frequent and administratively complex than the single life insurance payout. So while health is providing the exciting narrative of aggressive growth, life insurance is still the absolute foundation of their profitability.
And speaking of administrative complexity, there's a line in the report about their efficiency that really stood out to me. The ratio of administrative expenses to premium actually dropped slightly to 7.0%, down from 7.1% a year ago.
Yeah, it seems small.
Right. To a casual observer, a 0.1% drop sounds like a rounding error. Why should investors care about 10 basis points?
Because of the sheer scale of the denominator. I mean, when you are dealing with $1.29 billion in quarterly premiums, a 10 basis point improvement in admin expenses means millions of dollars drop directly to the bottom line without any additional effort.
Right.
This is the definition of operating leverage.
How does that actually work in practice for them on the ground?
Well, think about the mechanics of processing an insurance policy. It takes roughly the same amount of software computing power and the same amount of back-office human capital to administer a policy that costs $1,000 a year as it does to administer one that costs $500 a year.
Sure.
Globe Life is processing a 7% higher volume of total dollars coming in, but they aren't scaling up their payroll, their office space, or their IT costs at that same 7% rate.
Because their infrastructure is already built.
Exactly. It's largely fixed. So every marginal dollar of premium they bring in becomes increasingly profitable.
That operating leverage is a beautiful thing for shareholders, but getting that premium in the door in the first place requires actual human beings. Insurance doesn't just sell itself passively on a website, especially not these types of policies.
No, definitely not.
You need distribution channels, you need agents out there having conversations with families at the kitchen table, and that brings us to the ground level reality of their agent networks. We mentioned the health premium surging by 16%, and the report breaks down exactly who is out there selling it.
And one division really stands out here.
Oh, yeah. The United American division was the absolute star of the quarter. Their health premium skyrocketed 29% to $211 million, and their net sales were up 10%.
And to understand why that is happening, we have to look at the mechanism of what United American actually does. They are a massive player in the Medicare supplement market.
Okay, let's break that down for the audience. Why is there a 29% surge in seniors buying these supplements right now?
Well, traditional Medicare Parts A and B covers a lot, but it doesn't cover everything. It typically covers about 80% of approved costs, leaving the senior responsible for the remaining 20% out of pocket.
And there's no annual cap on that, right?
Exactly. There's no cap. So if you have a major surgery, that 20% can literally bankrupt you. A Medicare supplement policy, which is what United American sells, steps in and pays that remaining 20%.
I got it.
As the baby boomer generation continues to age into Medicare, the demographic tailwind for these specific policies is just enormous. Furthermore, United American operates as an independent agency channel.
Meaning the agents don't actually work exclusively for Globe Life?
Correct. Independent agents are essentially free agents. They have a whole menu of different insurance companies they can offer to their clients.
Wow.
So for United American to see a 29% jump in premium in a single quarter, it means independent agents across the country are actively choosing to sell Globe Life's product over the competition.
That's a huge vote of confidence from the open market.
It is. It suggests their policies are either priced very competitively, or their commission structure is highly attractive to the agents, or their brand reputation is just winning out.
But Globe also relies heavily on exclusive agents, right? People who only sell their products.
Yes, very heavily.
And those divisions did well, too. Liberty National saw a 6% increase in LifeNet sales, backed by an 8% increase in their producing agent count. Family Heritage grew health premiums by 9%, supported by a 7% increase in agents. The formula seems pretty straightforward. Recruit more agents, you get more sales.
Usually, yes.
But that brings up a glaring contradiction in the report that I really wanted to bounce off you.
All right, let's hear it.
I'm looking at the numbers for the American Income Life division. They are the biggest piece of the life insurance pie for Globe. Their life premium increased by 5% to over $466 million.
Yeah.
But their average producing agent count actually dropped by 7%. They shrank from 12,241 agents down to 11,391.
Yeah, that is a sharp drop.
I'm honestly stumped by this dynamic. How do you generate 5% more premium revenue while simultaneously losing almost 1,000 producing agents? My instinct tells me this is a red flag, like a delayed warning sign for next year. Am I reading that wrong?
It's a great observation, and it cuts to the core of how these agency models function. You're essentially seeing the Pareto principle, the 80-20 rule, playing out in real time.
Okay, how so?
In any large insurance sales force, a massive chunk of the revenue is generated by a very small percentage of top-tier, highly tenured agents. The rest of the agent pool often consists of newer recruits who struggle to close deals.
So they have a massive turn rate at the bottom.
Exactly. It is highly likely that the 1,000 agents who left were writing very little actual business anyway. Meanwhile, the tenured veterans who stayed actually increased their individual output. The company managed to squeeze more total premium out of a smaller but clearly more experienced sales force.
So the remaining agents are just dramatically more productive, doing more with less.
Yes, for this quarter. But your instinct to view this as a potential warning sign is entirely valid. Insurance is ultimately a numbers game. The top-tier agents of tomorrow are the struggling recruits of today.
Right, you need a pipeline.
Exactly. If your overall funnel of new agents is shrinking by 7%, eventually you run out of people to develop. You can only squeeze so much productivity out of a shrinking base before the top-line growth hits a wall. Management will absolutely need to reverse that agent decline in the American Income division to sustain growth long-term.
That makes total sense. So they are currently squeezing more efficiency out of a smaller agent pool, generating these massive amounts of premium every month. But what actually happens to that mountain of cash while it's just sitting there waiting to be paid out as claims 20 or 30 years from now?
Ah, the hidden engine.
Right. That brings us to the real magic trick of the insurance industry, the float. I always like to think of a life insurance company not just as a risk underwriter, but as a highly regulated, massive hedge fund that just uses insurance policies as a mechanism to acquire cheap capital to invest.
I mean, that is exactly how Warren Buffett built Berkshire Hathaway. The insurance operation collects the cash today, and the investment operation puts that cash to work until the claim comes due.
And Globe Life's investment portfolio is staggering. We are looking at roughly $20.7 billion in total investments, and they are generating serious cash from it. Their excess investment income was $38.3 million for the quarter, which is up 10% from last year.
Which is fantastic.
Let's break down the mechanics of that specific metric, because excess investment income really is the ultimate scorecard for this hidden hedge fund, right?
It is. Here is how the math actually works. The investment portfolio generated $293.8 million in total net investment income this quarter. But they don't get to just put all of that in the profit column.
Right, because of the liabilities.
Exactly. When they sold those life insurance policies years ago, they legally guaranteed certain minimum interest rates or returns to the policyholders.
That's the cost of the capital they acquired?
Precisely. That required interest on their policy liabilities cost them $255.5 million this quarter. So you take the $293.8 million they earned, subtract the $255.5 million they owe the policyholders, and the spread left over is at $38.3 million.
Wow.
That is pure profit generated solely by their investment strategy. The fact that they grew that spread by 10% year over year shows they are effectively capitalizing on the current interest rate environment.
And when we look at exactly what they are buying to generate that yield, it is heavily, heavily skewed toward fixed maturities. Out of the $20.7 billion portfolio, $17.9 billion is locked up in bonds.
Yep.
Breaking that down, it's $15.2 billion in corporate bonds, $3.4 billion in municipals. Now, management proudly notes that 97% of these fixed maturities are rated investment grade.
Very safe.
Right. And the portfolio yielded a steady 5.30% in Q2. But let's explore a counter-argument here. With 97% locked up in safe investment-grade bonds yielding just over 5%, isn't Globe Life kind of leaving money on the table? With their incredible operating leverage, why wouldn't they allocate just a small slice of that $20 billion to try and chase higher yields in other asset classes?
It is a tempting thought experiment, especially when equity markets are booming. But you have to remember the fundamental legal contract of a life insurance company. Capital preservation is not a strategic preference, it is a strict regulatory requirement.
Right. The regulators are watching.
Closely. Think about the timeline. They are taking premium dollars today from a 40-year-old to pay a death benefit when that person turns 80. If they chase higher yields by loading up on junk bonds or volatile equities, and the market suffers a multi-year crash right when a wave of claims hits, they risk insolvency.
They literally can't afford a bad year.
Exactly. A tech fund can tell its investors, we had a down year, hold on. An insurance company can't tell a grieving family, the market is down, we can't pay the death benefit right now. State regulators and ratings agencies mandate that 97% investment-grade safety profile.
That puts it in perspective.
And furthermore, generating a 5.38% tax-equivalent yield on a portfolio of that immense size with that level of safety is highly respectable. And there is a hidden tailwind here, too.
Oh, what's that?
If you look closely at the data, the new fixed maturities they acquired just in this quarter had an average annual effective yield of 6.3%.
Oh, wow. So the new money they are putting to work is earning a full percentage point higher than the legacy portfolio.
Right. So as older, lower-yielding bonds mature, they are taking that cash and rolling it into new 6.3% yielding bonds.
Yeah.
This means that even if they do absolutely nothing different, that overall portfolio yield of 5.38% is going to mechanically drift higher over the next few years.
Without them taking on a single ounce of additional risk. That is the ultimate benefit of a higher-for-longer interest rate environment for these legacy portfolios. And they aren't just hoarding this excess capital either. They are returning it directly to shareholders. Globe Life repurchased 1.1 million shares of its own stock this quarter at a total cost of $175 million. That averages out to $154.28 per share.
Which is brilliant use of excess capital.
Hmm.
When a company buys back its own stock and retires those shares, it reduces the total number of shares in existence.
It shrinks the denominator.
Right. So even if their net income stayed exactly flat, their earnings per share would go up mathematically because the profit is divided among fewer shares. It is a very clear signal to the market that management believes their own stock is an undervalued asset right now.
It's the ultimate display of confidence. So the financials look incredibly sturdy. The bond portfolio is a fortress. They are buying back stock. But management is legally obligated in these filings to tell us what actually keeps them up at night.
The risk radar.
Exactly. The forward-looking statement section of this release acts as the risk radar. What could potentially threaten this well-oiled machine? They list several macro and regulatory threats. They specifically call out the impact of inflation on consumer confidence, which could lead to unexpected changes in lapse rates, which is just the industry term for people stopping paying their premiums.
Right.
They also highlight a massive regulatory threat, changes to the federal Medicare program that would affect Medicare supplement policies. And right alongside that, they warn about seniors shifting away from traditional Medicare and toward alternatives like HMOs and managed care private plans.
And that last point is the critical vulnerability in their growth engine. Regulatory risk in the health insurance space is the ultimate wild card. An insurance company has actuaries who can perfectly model human mortality and sickness rates, but nobody can model the stroke of a politician's pen.
Man, this brings us right back to what we saw with the United American decision earlier. We noted they had a massive 29% surge in health premiums because they sell Medicare supplements. But if seniors increasingly choose all-in-one Medicare Advantage HMO plans where they don't actually need a separate supplement, doesn't that mean Globe Life's fastest-growing segment is built on a highly vulnerable regulatory foundation?
That is the exact tension investors need to monitor closely.
Yeah.
Yes, United American is printing money right now with 29% top-line growth. It looks fantastic on this quarter's spreadsheet. But management is doing their fiduciary duty by waving a massive yellow flag here.
Right.
They are essentially telling investors, enjoy the revenue growth today, but understand that the macro landscape for senior healthcare is evolving. If the government changes how traditional Medicare works, or if HMOs capture the entire senior market, the addressable market for Globe Life supplement products could shrink drastically.
That 29% growth rate could decelerate just as fast as it climbed.
Ex-
And it requires constant vigilance. They also listed operational and macro risks, like cybersecurity compromises or geopolitical events that could affect the debt issuers in their $15.2 billion corporate bond portfolio. If a cyber attack stops their systems from processing monthly premiums or a sudden economic shock causes corporate bond defaults, it would hit both their operational underwriting engine and their investment engine simultaneously.
It is the sobering reality of managing $20 billion in assets and millions of active policyholders. You have to constantly look at threats from a 360-degree angle, anticipating things completely outside your control.
Absolutely. So to bring all these complex threads together and summarize our deep dive for you, Globe Life delivered a textbook strong quarter. We saw a definitive beat on both the top and bottom lines, double-digit operating income growth, and a confident bump in full-year guidance.
We uncovered that they have a massive, highly profitable life insurance bedrock, functioning like a 30-year bond, paired with a fast-growing, though slightly more volatile, health insurance segment.
Right. They are managing administrative expenses incredibly tightly to create operating leverage, and they are navigating the agency model to drive higher productivity out of their top-tier salespeople, even as the overall headcount drops.
And all of this feeds a deeply insulated $20 billion yielding bond portfolio that generates so much excess cash they can aggressively buy back their own stock. It is a clear picture of a company executing its core strategy with high precision.
Which leaves us with one final thought experiment for you to pull on. Management explicitly warned about inflation leading to unexpected changes in lapse rates. So I want to pose this scenario directly to you. If the broader economy tightens over the next 6 months and everyday inflation bites harder into the middle class, will Globe Life's impressive 7% premium growth hold steady?
That's the big question.
Or are basic foundational protection insurance policies the very first hidden expense that families will quietly cancel when the monthly grocery bill simply gets too high? It's a fascinating behavioral economics question hidden deep inside a dense financial report, and it is absolutely something for you to keep a close eye on as we move into Q3. Make sure to follow the show for our daily earnings coverage as we continue to decode the hidden mechanics of the market one source at a time.